Hello and welcome, Citywire Germany here, today again from our little studio out of London. Today I'm thrilled that I'm joined by Benjamin Dean, who is the Director of Digital Assets at WisdomTree. Benjamin, first of all, thanks for joining me today.
It's a pleasure to be here.
Cool. Benjamin, today I would like to talk with you, of course, about the digital asset market. It was quite a volatile year, 2022, after a great bull run in 2020 and 2021. Let's just dive right into it. What were, in your opinion, the most important drivers for the crypto meltdown during 2022? And perhaps also besides the main factors like monetary and fiscal tightening that's affecting a lot of the macro landscape?
Sure thing. So I like to think about it in three levels. At the highest level, you've got the macroeconomic backdrop. I mean, it's been very dark this year, right? Interest rates have been going up. There's been conflict in Ukraine. So across asset classes, it's been a volatile year. We've seen in commodities, we've seen bonds and equities both going down at the same time. And so given that backdrop, it's been a really hard year in general. And digital assets are part of the economic system now, and so they aren't left unaffected. At the middle level, you've got the kind of internal dynamics of the industry itself. In the past, it used to be that Bitcoin would dominate the market, and every 4 years you would have this halvening, which is where there's a supply crunch for Bitcoin supply creation, and that would drive prices up. And we saw another one of these 4-year cycles play out at roughly the same time. Finally, if you look internally at the market now, one of the different things compared to 4 years ago was the prevalence of crypto lending. It didn't used to be the case that you could borrow or lend out your Bitcoin, your Ether holdings, or whatever cryptocurrency. And what we found in the last year was a very booming market, but one where proper financial practices and transparency weren't in place. And so as we saw that unwinding of the leverage positions, it continued the bull market back and back and back. So the good news is now that unleveraging has occurred. The good news is that we're 6 months down the line, further than we were before. And well, we'll see what happens macroeconomically, but it seems like the worst may be behind us now.
Seems to be all connected after all. Let's talk about Bitcoin and Ethereum for a moment. We saw a major new update in Ethereum 2.0 this year. Some market participants say that this could have some effects of the dominance of Bitcoin as it is at the moment. What's your view about that?
Well, Bitcoin and Ether are very different things. And when I sit down with clients, often I'll explain, there's more than Bitcoin, which is a surprise to a lot of them. And then I'll go on to explain that they're very different networks. They're designed to do very different things. And what we saw this year was a major upgrade to the Ethereum network. Remember that the Bitcoin network is meant to be very stable. It's not meant to change. That's part of what makes it attractive, the idea that it's not changing. With the Ethereum network, we do see upgrades from time to time. This year we had a very big one called, so-called the merge, which is the move to proof of stake. And since then, I found that the discussions are very different. When folks realize that there are these different networks and one of them functions very differently to the other, it totally changed the investment case in a way. So the discussions I'm having now are completely different to those that I would have had a year ago with our institutional clients.
That's quite interesting because Bitcoin, in the general opinion, is like the safe haven assets under the crypto assets, as it's limited to maximum 21 million pieces.
Yes, exactly.
That's quite a little bit different at the Ethereum blockchain layer, right? So there is basically code written, but this code is adjustable, isn't it?
Yes, so absolutely. So the software can update, firstly. And actually, you mentioned the Bitcoin 21 million cap. So we know how much Bitcoin will be created, and we know precisely when it will be created over the next 100 years. For the Ethereum network, it's very different. And it's important to understand that the Ethereum network evolves over time. Around this time last year, EIP 1559 was an update that was introduced to the network, which meant that when people use the network and pay transaction fees, part of those transaction fees are burned, in inverted commas, which is to say taken out of supply. And so what we've found recently is that people are using the Ethereum network so much that they're actually burning more Ether than is being created per day, which means that Ether is deflationary. That might help to explain a little bit why we've seen the changes in the price of Ether over the last 4 months. I'll remind you, like in June, it bottomed in inverted commas at $950 equivalent. It's now roughly 1,500. I mean, you can see the deflationary effects there in the price.
Cool. Yeah, let's focus our discussion a little bit on the broader landscape. I mean, we're heading into December and the Christmas month, and 2023 is basically standing in front of our door. 2022 was quite challenging. What do you think will be the story of 2023? From macro perspective, perhaps the current tightening approach will be a little bit more loose. This, of course, could lead to some more inflows into high beta assets, where crypto basically is also under. So what do you make of the year 2023? Are you optimistic?
The most important thing to remember is this. In 2021, last year, $28 billion worth of venture capital went into the crypto and blockchain space. And that was during a raging bull market, right? This year, 2022, at the end of August, the same amount, $28 billion of venture capital was invested again in the space. This is during, and we just spoke about it before, a very dark macro backdrop. And the venture capitalists continue to invest in this space. So what does that mean? It means that in the coming 12 to 18 months, wherever that investment has gone is going to turn into new companies. Some of those companies will find product market fit, and they will be the next set of opportunities that come onto the market. And that's approximately 12 months from now. So that's often, I find people are surprised at the idea that that much venture capital went in, and then they'll ask where was it invested? And we can talk about that if you'd like. Gaming, I mean, video gaming is bigger than US sports and Hollywood combined in terms of revenues each year, and has been for the last 5 or so years. That's where the venture capitalists are investing right now. And we will see those opportunities come onto line in the next 6 to 12 months.
Yeah, and I mean, like from a price action perspective, the two biggest coins, Bitcoin and also Ethereum, trading quite in a narrow range. So we definitely see no major breakout to the upside, but also no major breakout to the downside. So it shows kind of stability in the market, right? Right,
and it's somewhat anomalous. The last 3 months, and I point this out to people, as you've just rightly pointed out yourself, NASDAQ and S&P 500 are just as volatile as the Bitcoin and the digital asset space as a whole right now, which is somewhat unusual. You know, usually people would associate the digital asset space with high volatility, but we're seeing it across asset classes. It's an unusual time, but it's also, you find signal there. It's the resilience and stability of the digital asset market right now is anomalous. It's interesting. It suggests that there's something going on there that's holding it up, where other major asset classes are being very volatile.
A feedback that I often get from German asset managers and wealth managers is that the asset class itself would become more attractive if there was a decoupling process from Bitcoin, Ethereum, and co. from basically other high beta assets or the stock market in general, like NASDAQ or the S&P, like you mentioned before. Do you think that could be also another big driver for the crypto space itself?
Over time, what we would expect is if volatility is an expression of uncertainty, as time continues to pass and we continue to learn more information and the asset class, digital assets, becomes more and more established, I would expect to see lower and lower volatility. This is how a new industry develops. This is how a new technology is commercialized. And over time, what we find is, once it becomes more and more established, less and less volatile. And it's entirely expected from an industry that's driven by new technology. You only have to go and look at other new technological waves in the past to see the same pattern play out over and over and over again. It could be canals or electricity or railroads. Early on, high volatility, high uncertainty. But as technology is gradually commercialized and adopted, less and less volatility. And then the phrase I use is it becomes part of the furniture in the room. People just accept it. It's just the way things are done. And that's precisely what's happening right now with digital assets.
Do you also think that we saw these network effects with the internet adoption, that the same will be true for the crypto and the other part, the blockchain sector as well?
We're already seeing that play out. It's just the same process. The good news is that the digital assets ride on the internet rails. In essence, you have to have the internet in order to have digital assets. But we're seeing the same process play out, whereby a new way in which to do things that's faster, more efficient, more transparent, displaces the old system. And that's precisely what's happening right now. The same way the internet came along. Remember when people used to, maybe, I don't know, in Germany, if they say e-commerce?
They say, yeah.
E-commerce? Now it's just the way you do things. You just buy things on Amazon and it's done. There's similar things happening right now with the traditional finance, and it's being displaced by this digital asset infrastructure, essentially. You could say it's like the internet, but it's like, I would not get too narrow. Let's think about all big step changes in technological evolution, whether that's electricity or the railroads, oil and petroleum. It's a step change, and it just eventually ends up being the way things are done.
Big changes are coming. Benjamin, perhaps you can share a little bit about the discussions you currently have with your clients. Also in relation to where the institutional adoption is currently headed.
So you could take WisdomTree's institutional client base and put them in three categories. There's one category, which is family offices, hedge funds. I'll sit down with them and they'll teach me things about digital assets. So highly knowledgeable, and they have been involved in this space for quite some time now. They've got it all mapped out and understand very well what's going on in the space. In the middle, you've got private banks and medium-sized private banks, and I have a lot of discussions with that category right now, because they come to me and they say, my clients are asking, what is Bitcoin? Or like, how can I get exposure to digital assets with something like Ethereum? And they come, and I spend a lot of time explaining the space to them, because as in an advisory role, they have to have an answer for their client. If they don't have an answer, their clients pull their money and do it themselves. So I spend a lot of time explaining this space to them, just as we did before. You know, Bitcoin and Ether are very different things, right? And then there's a whole other space, the digital asset ecosystem, that's highly experimental, but we spend a lot of time discussing that. The final category has relatively recently started turning up, and they are large asset managers, pension funds, and insurance companies.
So the big players.
And the reason they're turning up is one of the points you mentioned before, which is the Ethereum merge. That has completely changed the investment case for a lot of large asset managers, insurance companies, pension funds. They come to me and ask, what is this Ether? I hear it uses less electricity, I get a staking yield, and I hear the Ethereum network continues to be upgraded. That's the discussions I'm having now with that group. And those people, 1 year ago, weren't discussing it, but now they have to. Because if they don't have an answer, they don't have an explanation, someone else is going to go and move in there.
So basically their sentiment is not as bearish as the market currently seems. They don't say, well, there's so much volatility, or there was so much volatility at the beginning of the year. towards the second half of the year, and it's a reason for us to really stay away from these assets. So what you basically say is they want to experience and learn more about the asset class and learn how to build exposure in it?
What I'm saying is that we've reached a point in terms of adoption of digital assets where it can't be ignored anymore. Last year, the Collins Dictionary word of the year was NFT, non-fungible tokens. So basically what's happening is that it's a space where like 10 years ago, it was usually just for people who like technology. It was very niche, very hobbyist, a little bit like people used to build their own televisions or build their own radios. So that was 10 years ago in the digital asset space. Now what's happened is it's become much more mainstream. And so the NFT example, it's like, these are people, some of my friends, they work like in Hollywood or in music. They're plugged into the cultural scene, right? And they come to me last year and they'd be like, why didn't you tell me about NFTs? What is this? You mean I can monetize my intellectual property? I can engage with a fan base and do basically what I did with social media, but on these kind of crypto rails. It's a totally different set of users, and it's a totally different way in which to use this technology. All I'm seeing is it go more and more mainstream. It's becoming, as I said before, part of the furniture in the room. People won't even know that it's crypto in the future. It's just the way things are done. And we've just basically got to deal with that.
I mean, like, NFTs had also a major bull run in 2021. Everyone was talking about these monkey pictures that were going around the internet. Where do you see the main use cases of NFTs going forward? Is it just to, if you're an artist or something like that, to make collectibles out of your knowledge, out of your skills, or where do you see the major use cases for NFTs?
So it's true that last year kind of was, it's funny because it's so silly. Monkey pictures, monkey gifts being sold. I mean, that was a very small portion of the market. It gets a disproportionate amount of attention because it's so silly, right? Going forward though, what's going to be interesting is this idea that what is a non-fungible token? It's a script. It's a software code you can write, and it's unique in the way in which it's cryptographically hashed. I suspect what's about to happen is we're about to see it move into, well, gaming, the first thing. People already exchange and buy digital collectibles in the video gaming world, right? But then there's also an interesting use case which is in the traditional finance sense. Like, you could end up having assets that are written up as an NFT, an online script, that replaces ways in which traditional finance works now. It's just the database on which you store the information is different. And once you realize that most of finance is basically moving ones and zeros around databases, and then you think about the idea that, well, which database do we store the information on, you start to see why NFTs would actually be something that would be very useful in traditional finance.
So you basically also say that NFTs would be a great thing to digitalize our, well, financial infrastructure in some way, to digitalize how we trade assets. What do you think would be the main difference in the way we do it at the moment compared to how we could do it with NFTs? For example, if you would like to buy a stock or if you would like to buy property.
It's all about where the information is stored. Right now, a lot of information is stored in databases that certain companies hold. They don't give access or transparency around it to other people. What's happening right now is that you're moving the data onto distributed databases that anyone can access, anyone can look at, anyone can do read-write. And so basically it breaks down the walls around rent-seeking, around the information that people will be able to store before on the databases. So in that sense, it's like a hyper-transparency, but also it removes a lot of the friction that currently means that there's a lot of folks who are able to extract rents out of systems that they control, but in the future, It'll be all on public databases called the blockchain, in inverted commas.
Interesting. Yeah, we will definitely watch how this will play out. Talking about NFTs, talking about cryptocurrencies, we also have to basically talk about the metaverse, where Facebook is making huge investments into the metaverse application. Where do you see the opportunities in the metaverse sector at the moment? And is there also, or are there opportunities for the finance industry, like banks, asset managers? Do you have a own little vision of how the metaverse could look like?
I have a lot of discussions with people about this metaverse. The metaverse has been with us for a very long time. It's basically any situation where we're conversing with other people or communicating via some medium. Radio is a metaverse in a way, and so is the telephone, right? Video games, anyone who's a gamer knows metaverse. But the more interesting thing, and you've just touched on it, is the merging of big tech and finance. So it's true, Meta, formerly Facebook, has been investing a lot of money in trying to build a metaverse. The more interesting scenario is the following. What happens if Meta simply plugs in the Bitcoin or the Ethereum network into their software? All you have to do is write some script, and suddenly what does Meta become? A bank. Remember that they had so much trouble with the regulatory issues around Libra, and it turns out that most of social media, like the software code, looks a lot like a bank. It's not a bank, but it wouldn't take very much to change the software, plug in the digital asset networks, whether it's Bitcoin or Ethereum network or another network, and suddenly the banks would have a very hard time. Because I imagine you use a social media network.
Of course.
You maybe use WhatsApp.
Of course.
It wouldn't take very much to update the software, and suddenly your money is in your WhatsApp wallet, and that would change how you manage your financial life very quickly. That's something we keep a very close eye on, and is part of what we think is occurring. The blurring of the lines between the digital assets, crypto, and the traditional financial system. And it's really just going to be a question of who seizes it. I have a Twitter account. I can already accept Bitcoin payments on my Twitter account. You watch. It's suddenly they're going to be the same thing. It'll either be your social media account or your email account, or someone is going to just plug into the digital asset open source network, and your bank will be your social media account.
And now with the overtake by Elon Musk, these things could probably accelerate even faster. One thing I'm still wondering is, many companies try to build a metaverse, so everyone wants to build their own metaverse. And I'm still trying to process, will there be one major metaverse where all the players will be in, everyone from the world, or will each company, each game, or for example, Meta will have its own metaverse, Apple will have its own metaverse, and Microsoft will its own metaverse? What you make out of that?
That's a really good question, because a lot of people over the years have said with the digital asset ecosystem that it would all converge to a winner-take-all model. Bitcoin would win, in inverted commas, it would dominate the space. And that is not what happened. So the winner-take-all dynamic actually isn't as strong as a lot of folks think. So to get back to your question, what will end up playing out? I suspect there'll be multiple metaverses, as there already are right now. And there will be different spaces, basically. You do different things in different spaces. They'll have different configurations. That won't mean you can't build a very big company around it. But I don't think a winner-take-all dynamic, it doesn't seem like it will play out. And even if it did, it seems like it will be short-lived. I mean, do you remember the search engine Lycos?
Yeah.
In Alta Vista, right? Network effects can go one way, but they can also go backwards very quickly. And we see that in the digital asset space. I mean, people have been talking about Cardano for years, Avalanche. I mean, Phantom just went backwards. It's like people experiment with new technology, and they can very quickly build up the network effects. They can also go backwards very quickly. It's highly, highly competitive. And when it's open source software, anyone can fork it. So I would be surprised if there was one network that kind of emerged to rule them all, because that's just not the dynamic we've seen in the recent past.
Interesting. Benjamin, let's touch one last point here. We often talk about cryptocurrencies, we talk about blockchain, and we throw all these words into the same bucket. But the blockchain can have quite different use cases than cryptocurrencies, for example. Where do you see the perspective for the financial industry in terms of blockchain usage going forward?
So one of the most popular things, and it's somewhat ironic in a way, one of the most popular things on digital asset networks is something called stablecoins. That's not a very good word, actually, because what they are is, for the most part, US dollar pegged tokens. Now, in January of last year, 2021, there was maybe $6 billion of US dollar tokens, stablecoins. By the end of the year, there was 160 billion. So they're like euro dollars running on different software, essentially. Now, if you can have a US dollar token, you can have a gold token, you can have an equity token, you can have tokenize anything, really. It's just a way of storing information and then moving the information around. You watch, it's become very obvious that you can tokenize the assets and you can store the information on these distributed ledgers, blockchains. It's faster, cheaper, more transparent, fully auditable. I mean, it's like on several dimensions, a much better way in which to run financial technology. And so basically we're going to see that play out now. We're going to watch folks tokenize. I'm sorry, it's not a very nice word. It feels a bit vague, but it's the idea that you store information on an open source distributed ledger and you watch who will be able to compete against that. If you've got a faster, cheaper, more transparent and more auditable system, more trustworthy, that's probably the most important element. It's going to have to move that way because it's just better on at least 5 dimensions I've just mentioned. There's maybe more.
You also mentioned the word stablecoin, quite a polarizing topic itself, where we still have Tether, and we still don't really know how it's actually backed, and are all these securities somewhere deposited?
Now, it's not true that we don't know what's backing Tether.
Okay.
And actually, it's a really interesting dynamic that's played out in the last couple of years. So in the past, Tether, which is, as you know, it's a US dollar pegged token. In the past, they were not very transparent about what was backing the token, essentially. And what's happened is there's a huge amount of competition now. There's a company called Circle, and Circle issues a US dollar token as well. It's a regulated financial institution in the United States. And that level of transparency meant basically people would vote with their wallets. Do I want Circle, a regulated, transparent, stable coin, US dollar token that I know is backed by US dollars and short-term treasuries? Or do I want Tether, one where I don't have that amount of transparency? And sure enough, it's forced the Tether group to actually be very transparent about their holdings. They've just announced that they've let go of their commercial paper holdings. And in a way, they've started to emulate Circle. So we're seeing kind of the market play out. Folks vote with their wallets. What do you want? Do you want something that's transparent, where you know what's backing it? Or do you want something that's not transparent? You don't know what's backing it. And sure enough, people vote with their wallets, and they're going for the more transparent alternative.
Fair point. And we also saw some washouts, some implosions of other stablecoins, like Luna is one example I can remember. But the other question that I would like to ask you is, do you think that Fed-issued stablecoin would solve some of these transparency issues and would also be a use case that would work, or a scenario that would work for adapting it in the sector?
A fiat-backed stablecoin,
Yeah.
did you say? Well, in a way, that's exactly what, well, we use the term stablecoin. It's not a very good term. That's what they already are. I mean, they're backed by US dollar deposits or holdings or short-term US treasuries. We're already seeing that play out. Now, one of the discussions I have a lot right now is, and you didn't use the term, but I'll introduce it here, central bank digital currencies. Mm-hmm. It is, in the last 3 months, it is the question that comes up all the time. And what's super interesting about it, in a way, is the admission that this new technology is just better on several dimensions. And so the central banks have been asked now to come up with their own alternative to this. Because people are just, as I said before, they're voting with their wallets. You can hold your money in a bank, if you want, or you can have a US dollar stable coin on your cell phone. What do people pick? It turns out in lots of parts of the world, people would rather the digitally native, faster, cheaper, more transparent alternative to holding it in their bank. And so we're seeing with the central bank digital currency movements, we'll see if they're able to compete. I'll be surprised if they can roll the technology out. And
also, I might add, by now, me, for example, I'm not using any cash anymore. Basically, what we do is transferring some digits from one account to another account, but this physical aspect of money transaction is getting less and less needed, right? So there could be a bright future for the technology. Do you think so?
Maybe. It depends. Depends if you are able to control your money. You know, one of the interesting things about this whole digital asset space is this idea that you hold your private keys because you digitally sign with a public-private key combination. Its technology has been around for a few decades, but the idea that you hold the private keys, you control what can and can't be done with your money. Mm-hmm. If people have got their own private keys that they control, that they own in inverted commas, then it might be a very bright future. On the other hand, maybe they won't. And then, I don't know how you have, if you like people having control over your money, but there's lots of parts of the world where you wouldn't want to delegate your authority to someone else to control your money. We'll see how it plays out, but the good news is the technology's there. It's now just a question of making it usable so that people are able to make their lives a little bit better.
Great, Benjamin. It is a polarizing topic, and it will be a big topic in the future as well. Thank you very much for taking the time today and really going through all these quite interesting topics.
It's been a pleasure. Thank you.